Well, some countries are selling. That's definitely a factor. But we don't know how much of a factor it is in the moment because they don't report what they do until later on. But yeah, there was a lot of selling going on at the beginning of the Iran war, and there's no reason to think that there wouldn't be some selling now as countries grapple with sudden energy shortages. So that's probably part of it. And another part of it is that stocks in general are tanking, and that normally pulls precious metals down. If you look at 2008 or 2022, in both cases we had dramatic and quick bear markets in equities, and gold and silver tanked right along with them. So historically, this is kind of a normal thing. It doesn't really say anything about gold and silver at the moment, except possibly with interest rates going up. It could be that suddenly we're expecting monetary tightening, and that's not normally a great thing for gold and silver. I don't think the monetary tightening story has legs, though, because as soon as there's any kind of a crisis out there, the Fed will shift over to massive easing. And, I think what's happening in the stock market now, if it continues, if we have some more bad days, then we'll stop hearing about the Fed tightening and start hearing about how aggressive they're going to be with their upcoming rate cuts. And what has happened in the past is that everything tanks and gold and silver gets pulled down along with equities, and then the central bank aggressively starts easing, and then that liquidity flows back into precious metals, and they do okay again. So I think that's probably a big part of the precious metals story right now. And the nice thing about that is it has a happy ending historically. And it's just a question of when the Fed shifts gears and starts talking about tightening. And I think it could be any day now, just a couple more days like this, and they're going to be in full panic mode. I've been repeating that message ad nauseum on Substack, which is don't jump with both feet into anything just because it looks good in the moment. And with gold and silver, we should keep our eyes on the eventual prize, which is a monetary reset somewhere in the intermediate term future, where gold moves back into the center of the monetary system at maybe $15,000 to $20,000 an ounce, and silver is pulled up by that to a couple of $100 an ounce. Keep that in mind, and then gradually add to really good high quality names. In other words, buy physical gold and silver to start with, make that the bedrock of your financial life, and then start looking at commodity stocks, because commodities are extremely cheap compared to financial assets right now. So buy the highest quality gold mining and silver mining stocks a little at a time. And then once you feel like you have enough of those, dollar cost average or use lowball bids or whatever to get into the mid tiers, and so on, and educate yourself along the way. Learn from your successes and failures with your initial small positions in these things, and then use that knowledge to make better decisions about what you want to be adding. And so this is a long-term process. We shouldn't be looking at any single trading day and changing our strategy based on it. And right now, if you have some low ball bids out there, actually, I did a Substack post a while back about using a low ball bid, how you do it and everything. And it was with Hecla Mining, which is a big silver miner. And it just got hit a couple of days ago. So now in our portfolio is Hecla Mining at $15 a share. And we all know how to use low ball bids to buy cheap stock right now. Now, Hecla has to stop falling, though, because it's already down to $14 this year. So one of the risks if you use lowball bids is that the stock you're trying to buy just blows right through your bid price, and you have to put up with a kind of a V bottom before it goes back up. But and dollar cost averaging is kind of a similar concept where you buy the same dollar amount of the high quality assets that you want to get into, say each month, and when the price of those assets is up, you get fewer shares or fewer ounces. When the price of those assets goes down, you get more shares and more ounces. And so over time, you build up your positions at a really favorable average price. So this is another situation where that is a good strategy because things are tanking now. So if you're putting X amount of dollars at the end of this month into some good gold and silver miners, for instance, all of a sudden you're going to buy more shares than you bought last month and the month before. So your average price is going to improve. And, times like this really validate that kind of gradual, steady accumulation and a complete lack of interest in what's happening in the moment. First of all, let's examine the difference between a secular high when everything has made its peak price and it's headed back down, and a correction within a bull market. And that has almost nothing to do with the assets in question. Like gold and silver aren't doing anything right now. And whether they're good investments going forward depends on whether we're still in the same situation with the same big trends that led them to go up in the first place. And the big trend that we have to be watching, because it tells us whether we're at the end of the cycle or just in the middle of the cycle, is government finances. If governments are still running massive deficits and still having to finance those deficits with a torrent of newly created currency, then we're right where we've always been. We're debasing our currencies. We're basically destroying the world's big fiat currencies, and that's going to lead to a currency reset with gold and silver much higher. So until that changes, then we're still in a bull market for precious metals, and that is emphatically not changing. All the big governments of the world are running insane deficits, and they're having to create a lot of new currency to cover the interest costs. So we shouldn't be worried about this being like 1980, which is the secular end of the gold bull market, and 20 years of down prices are coming. The fundamentals don't point towards that. They point towards higher inflation as governments get more and more desperate to finance their way out of the debts they've taken on, and that's good for gold and silver. So what's happening right now is not something that is the end of a cycle. It's more of a midterm course correction, consolidation kind of thing. So we shouldn't be worried about where we're going to be in 5 or 10 years. And in the meantime, trading, making decisions when markets are being very tumultuous is just hard because your emotions get wrapped up in it. And that's why just adding gradually to the positions that you like takes a lot of the emotions out, because you know what you're going to do. You know what you're going to do at the end of the month. You know what lowball bids you have in place and where you'll get taken out. And you don't have to decide in the face of the markets going crazy. So I think any kind of a rule you can set up for yourself that takes some of the emotion and some of the angst out of it is healthy. And I think a focus on long-term trends rather than short-term squiggles in the market is also healthy. So as long as we're in the process of destroying the world's fiat currencies, we definitely want to be continuing to accumulate gold and silver. The future of America's standpoint. But yeah, with gold and silver right now, they're tanking, which, isn't a surprise given what's happening in the markets overall, because, each time the stock market has tanked in the past 20 or so years, it pulls down commodities too. If your tech stocks are giving you margin calls, then you've got to sell something else in order to cover that. And so it bleeds over into all the different sectors. Even the ones that are still relatively cheap. And that's what's happening with commodities in general right now, and gold and silver in particular. So let's talk in a little while about how you play that as an investor, but focus now on the reasons that it's happening. And, first of all, the Iran war is just dragging on. They just shot down a U.S. helicopter, and Trump just came out and said, well, we have to respond to that. And the big chunks of the world are running out of oil or diesel fuel or jet fuel. And that hasn't happened already because most users of petroleum products keep some reserves. And so now everybody's run through their reserves, or most countries and a lot of big companies have run through their reserves. And so now they're hitting bottom of the tank situations in a lot of places, and that's going to spread to the global economy if we don't fix it immediately. And by fixing it immediately, I mean start the process of getting supplies shipped to where they have to go and everything. And then over the next few months, maybe with luck, go back to normal. So this is a lot more consequential than it seemed when it started. And, where we're going is probably a lot more consequential because, the U.S. government is under a deadline. We have a midterm election coming up that could easily hand Congress and the Senate back to the Democrats and basically hamstring the government, or worse. I mean, it's likely that those guys, if they take over the Senate and Congress, will immediately impeach Trump, try to throw him out of office, and then try to put him in prison. And that's all we need as an economy to have that kind of chaos. But it's something that we're really staring at right now. We'll see a lot of financial response to it, where people start loading up on gold and silver, which they have been doing, for the past decade or so. But they start doing it in kind of a panicking way now. So you've got the central banks out there knowing this is ending, and they're buying gold in order to back their currencies when the current crop of fiat currencies break down. And you've got people starting to figure out that, gas is up to $6 a gallon, and what should I be doing with my investments in that kind of an environment? And so I think the commodities sector, which is made up